Hello everyone, this is Nitesh, Sinha, Assistant Professor, Techno Group of Institution, Lucknow. We are discussing about the cost accounting. Cost accounting is the process of recording, classifying, summarizing and allocating cost associated with the process. After that, developing various courses of action to control the cost. Its goal is to advise the management on how to optimize business practice and process based on cost efficiency and capability. Cost accounting provides a detailed cost information that management needs to control current operation and plan for the future. Since managers are making decisions only for their own organization and there is no need for the information to be comparable to similar information from other organizations. Instead, information must be relevant for a particular environment. Cost accounting information is commonly used in financial accounting information, but its primary function is for use by manager to facilitate making decision. After all type of business, whether service manufacturing or trading, require cost accounting to track their activities. Cost accounting has long been used to help managers understand the cost of running a business. Modern cost accounting organized during the industrial revolutions when the capabilities of running a large scale business led to the development of systems for recording and tracking costs to help business owner and manager make decisions. In the early industrial age, most of the costs incurred by a business were what modern accountants call variable cost because they varied directly with the amount of production. Money was spent on labor, raw material, power to run factory, etc. In direct proportion to production, manager could simply told that variable cost for a product and use these a rough guide for decision making. Some costs tend to remain the same even during busy period, unlike variable cost which rise and fall with volume of work. Over time, these fixed costs have become more important to manager. Example of fixed costs include the depreciation of plant and equipment and cost of department such as maintain tool line, production cost, purchasing, quality control, storage and handling, plant supervision and engineering. In the early 19th century, these costs were of little importance to most business. However, with the growth of railroads, steel and large scale manufacturing, by the late 19th century, these costs were often more important than variable cost of a product, and allocating them to a broad range of product led to bad decision making. Manager must understand fixed cost is order to make decision about product and pricing. Types of accounting: activity based accounting, environment accounting, project accounting, resource consumption accounting, standard cost accounting, target accounting, throughout accounting and life cycle accounting. Element of cost accounting: raw material, manual labor and expense and other overheads. The development of throughout accounting as business become more complex and began producing a greater variety of products. The use of cost accounting make decision to maximize profitability came into question. Management circle become increasingly aware the theory of constraint in 1980s and began to understand that every production process has a limiting factor somewhere the chain of production. As business management learned to identify the constraint, many increasingly adopted to throughout accounting to manage then and maximize the throughout dollars.